Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 3rd, 2016. And I'm starting this video in pre-market today. It's a little before 9 o'clock a.m. Eastern Time. And we'll take a look at the charts, where we're at, where I think we are, where we might be headed in the next in the coming days here. Really looking out near term. It seems to be, by all accounts, this rally is most likely close to, or may have already run its course. I mean, futures right now are trading flat. I'm looking at the futures and pre-market. Everything's flat right now, so we'll see where we go. But these are let's focus here on the 60-minute charts. We'll start out with, this is the bearish rising wedge pattern. We have these on just about all the major U.S. indexes. This is the S&P 500 we're looking at. So prices continue to push higher. A very clean, well-defined wedge. I'm sure these wedges are well watched. It gives me a little bit of pause, but then either way, you have to sometimes just trade the charts for what they are. So what I'm getting at here is we're right now very close. We're really at about the point where these things start to break down, give or take 70 to 80% towards the apex of the wedge. The apex is where the two points come together and converge. And so anywhere in this zone here, we're also, if you look at this level here, this horizontal line, I'll color it. This is the what was the former support shelf from the late 2015 trading range. Remember, we had that sideways trading range, which broke down right after trading started after the first of the year, and that kicked off that first leg down, and that's right around 1990. I mentioned on the other charts, and we'll get to we could really push up to 2000, no problem. But we're getting to that point. So the whole theme of what I'm trying to do here is the trend is up. There's been some great opportunities. The longs on the site, most of the longs right now, the active official longs are the growth and income trade ideas, and they've been doing great, especially for what they are. Those are high dividend paying stocks. And that's one reason I put a lot of growth and income trade ideas on recently, because I do believe there's still a good chance we're in the early stages of a bear market. And if you're going to trade longs or hold longs, especially for longer term trades, if you get those high dividend paying stocks, also defensive stocks, there's a utility long on the site right now, and those are the ones that tend to hold up better and can, in some cases, actually rise during a bear market. But either way, they've been doing well lately. I've also, in the last few days, we've had a few risk-on trades, such as the CHK yesterday and a couple others. So that's been the theme, and that's what I'll talk on. Yesterday was, without a doubt, in the last few days, I should say, has been certainly a risk-on trade with a lot of the smaller, low-priced stocks outperforming the larger mega caps, the blue chips. And so this is where we're at, guys. We're right at that now, at the point, getting very close. We closed at 1986 with that resistance, really, the whole world's watching that 1990 level. I also mentioned this in the video recently, the last video update I did. From my experience, if this is the level everybody's watching, we're either going to fall short or we're going to go past it. Now, being the fact we're already at 1986, that's just close enough for government work, we're probably going to go past it, is my guess. However, I use the term picking up nickels in front of a steamroller, and that's what you're doing with longs right now. I don't mind taking, especially those high beta names like the Chesapeake trade yesterday, take it, hit it hard intraday when you see those intraday patterns. In other words, as I said, I start out with a swing trade position that bull flagged on the intraday chart, so then I was able to add to that, a large amount just to play for that intraday pop out of the flag, and then the first target was hit. So, they don't all play out that well, but that one, from a scale 1 to 10, that was a 10 with technical analysis. The chart's just confirming everything, volume, beautiful, symmetry on the flag action, or the pennant, but bullish pennant, sorry about that. So that's what's going on. So if you're an active trader, a nimble trader, the trend is up. The risk on trade is working right now. But just remember, you're playing a game, you may be playing a game of hot potato, except instead of tossing around a hot potato, you're tossing around a hand grenade, and you don't know how long that timer is going to go off. So what I'm trying to say is, if you're caught holding these low-priced stocks with horrible fundamentals, like a lot of the energy companies like Chesapeake, and all of a sudden the music stops, meaning this market, the whole market starts going down sharply. That stuff will fall so fast you won't know what to do, especially with overnight positions. This is what I try to emphasize when you're trading those little names. Sure, they're doing great. But you can wake up to a 20-30% plus gap down, especially when you're trading stocks that are under the $5 range. So be careful with that. But again, it's all to your skill set and your risk tolerance. So if you are active and nimble, that's where the money's to be made right now. And as an active trader, you have to engage these markets and strike while the iron's hot. And that's what's been going on here. But the rub here, the dilemma is we're now the bigger picture shows us pushing up to some major resistance areas where we may punch through them a little bit, fake out. We could turn down. This one could play out textbook. We could come up, hit 1990. Turn around, come down here and break that down from this bearish rising wedge pattern, which would bring us back to this point, at least. What I mean by that is I'm just using a rough measuring. You take the distance of a wedge, the widest point, and then you add that on, and again, you can add it to the top of the wedge. Often I'll see it from where prices break at the bottom, and that would bring us down to this level I have here. Although there's a good shot that if this was a bear market rally, this could spark the next major leg down. So that's really, and I'll communicate my thoughts more on that later. All right, enough on these intraday charts, although we'd be remiss not to look at the NDX. Same pattern. This is 60-minute on the NDX. It's these divergent highs and lows on the 60-minute frames that usually give you good swing trades. So even if you're not a very active trader, but you're, a swing trader with a time horizon of, a few weeks on a trade, minimum of a few weeks, I should say, then these are the patterns you want to look for, at least 60-minute time frames. Don't pay too much attention to the 5-minute charts, the 1-minute charts. But when you do see divergence and well-defined patterns on a 60-minute chart, those are the ones you want to position short for. And, there's two ways to do it. As just showed you on the S&P, we're really at the bottom of that resistance level, resistance zone. On the Qs, as I mentioned, this is the NDX. We can go back a little farther and you can see it. Here's that whole trading range from back in late 2015. Let's see if I can box it in here. Nope. Okay, there it is. So, that's pretty well defined, and that's what kicked off the party right here on the short side when that broke down right after trading started after the first of the year. And as I just mentioned earlier when we were looking at the S&P 500, the NASDAQ, because it is a higher beta index, higher beta against the S&P, meaning it goes up more when things are good and it tends to go down more when things are bad due to the heavy technology and more aggressive higher beta stocks in there. So as such, it led us on the way down and has only retraced at this point about 50%. You can see over here on the left right here, that's the 50% Fibonacci retracement level, and that's right where the Qs are currently struggling. However, they can go up. You look at you had that divergence I mentioned on the daily chart, positive divergence. It's not shown here. And there's the top of that support zone. Again, let's draw it out just a little bit longer. I boxed it over there, but it does extend all the way out to here. So there is that possibility that, just based purely on the charts, looking at major resistance, that would be the key resistance level on the NDX. So that's where we're at. We have the SPY has already come back to test the bottom of its range, but as I mentioned, can push higher. I hear everybody talk about 1990. So why not go up to 2000, maybe even a little higher? And same with the NASDAQ. I mean, let's say it continues to push up. It'll foil a lot of the... Remember, we had all that bearish sentiment that I just talked about, the extremes. I went over that in detail in the last video, so I won't harp on that again. That stuff may or may not have been flushed out. In fact, I'll almost assure you there's still a good a percentage of shorts that are riding this thing out, saying, well, heck, I'm in it this far, I might as well wait. We're at 1990. We're going to reverse any minute. And remember, the markets just have a way of not letting those that are positioned for a move get that move. So if you have a lot of short interest, you have a lot of put holders right now betting the market down, more than likely before we see the next major thrust down, they're going to have to clear a lot of that out, probably more than's already been cleared out. So that's why I could see this push up here. And that would be another level that maybe some of the shorts are watching and willing to hold out for. And if that's the case, then why not take it up here? Look at this big gap right here. Let's color that line a little different. We'll put that as a red line, because this red line, and I think I went over this in the last video, these are the areas I'd really be concerned if we took out as far as the whole larger picture that I have right now, that we have already embarked on a new bear market, and there's a lot more to go. You can look at this line, see all the reactions. Look at this gap. That's a huge gap. Gaps act as magnets. Usually, most gaps are backfilled. This one hasn't been backfilled. That would be a beautiful level to backfill. And I'm talking from the longer term perspective if you are wanting to position for the next leg down, because that would blow out a lot of shorts right here if we got back above the bottom of that trading range I was talking about. So you have that gap there. You have gaps in here. You have reactions. Look at all the reactions. Big gap again. Reactions back here. On a scale of 1 to 10, that's got to be an 8 or a 9 as far as a resistance level. Remember, and this is also a very, very important resistance level. Don't get me wrong, about 44.80. But that would, as I said, for the bigger picture, it would just blow out a lot of short interest to see us push right up through that level and then come up here. And now, resistance at some point is resistance. And when you get to challenging the previous highs, where we are in the scheme of things, I don't think this market has any business getting past this red line. So again, if we take that out by more than just maybe a 1 or 2 day quick, final flush out move, blow off top, that's all I would allow for. Anything more than that would probably just clear the way for new highs. So that's not my scenario up there. These are my scenarios, and I wish I could say exactly where we're going to turn down. Remember, those wedges are there, so respect those. If we turn down and break the bottom of the rising wedges that I just looked at on the 60-minute, then you need to be, on alert for a possible, nice wave down in the market, at least for a few days or a couple weeks. However, right now, I'm just kind of taking it day by day, and if I see evidence of a reversal, I'll jump in short, more aggressively short. And what I've started to do, the other day I mentioned I took a very small position, and I'll probably can add to that today here, and very well may start booking some profits. My plan was originally and still is to get out. I don't want to be long past this point. In fact, I want to be net short here. So this is sort of a plan. Maybe begin scaling in now, or continue to add on the shorts, reduce longs. If I see any of these day trading ops, as long as the music's playing and these little stocks are popping, sure, I'll get in, get out, but I'm not going to take home, especially those more aggressive ones. I wear different hats. I have, long-term accounts, and that's where I have the MOS, POT, NAT, a lot of those growth and income stocks that I think have potential, and I think will also hold up relatively well if the market takes another leg down. And then the trading account is where I do the hit and run trades for the most part. And so this would be really, unless anything changes, maybe an all-in, what I'd call an all-in short. Doesn't mean every penny I have, but where I'm fully net short, not really interested in longs anymore, and with stops somewhat above, above that level right there. And again, I'll just have to watch the action as it comes. So I think a reversal can come at any moment now. It could come here, and that's why I talk about a scale in. In other words, don't get fully short here, but kind of work your way up. And at this point, if you are looking for the next wave down, so you want to add as we go, and strategically. I also mentioned the other day, I think yesterday, that I'm looking at it and I still see a lot of bullish charts that have a lot of potential. There's a lot of energy stocks that seem to be bottoming, and there's some of the biotechs look maybe ready for another leg down, but then some of them look good. So there's just a mixed bag across the board, and I don't think it's going to be that easy. So I'm also open to the possibility of something like this over the next few months, a choppy sideways trading range on the NDX here. Or on the market as a whole, where we just kind of chop around and grind around, maybe hit the top of that range, come back here. This would just it would frustrate a lot of traders, and if you're trading the broad market indexes, let's say you're loading up on QID or SDS or one of the leveraged or straight out shorts on the equity markets, this would be frustrating to be caught up in this for a couple months. Whereas if you're trading the best looking stock setups on the long side and the most bearish looking stock setups on the short side, you can make money. And it's also a way of doing a hedged portfolio. So that's how at times I like to trade, being long the most attractive sectors or stocks, short the most bearish, and that way if I get my call on the market wrong, I'm not, my whole portfolio is not moving against me. It's a way of hedging my bets, so to speak. And if you do it right, you can make money on both sides. You can, especially in this kind of market, the sideways market, you can make money on your longs and your shorts. Okay, real quick, we'll touch on the daily chart. This is the NDX NASDAQ 100 daily chart. There's the positive or bullish divergence that was put in on the daily time frame. And as I said, even in a primary, when the primary trend is, let's say, bearish or bullish, and then I see 60-minute positive divergence out on the 60-minute time frame on the index charts that go against that trend. In other words, in a downtrend, you see a bullish divergence. Even at the 60-minute frame is when I typically cover shorts, most if not all my shorts, and then reverse long, especially when the markets are, when that divergence coincides with support, which we did recently. Now what I'm putting out here is this is on the daily time frame. The longer the time frame, the more powerful and more significant that divergence is, and that is exactly what happened. It played out. Now the question is this enough? We had divergence. It's not shown on the NDX. I think it was on the SPY. Some of the indexes back here, we had positive divergence, and it played out for a sharp move. Don't know yet. It's hard to say. There's a 200-day moving average right there. You can't see it. There's a red line. That's a key level on the NDX, which is coming in right with this horizontal level here. So about 43.60. We closed at 43.34, so just above at 43.60ish, call it. I have a resistance level. Gets pretty thin before there. If we push up, punch up through there, this is where it starts to get really thick here, about 45.01. That was at one of those levels I just mentioned, I believe, on the 60-minute chart. And then here's that level with the big gap. Remember the two gaps we were just looking at on the 60-minute chart, and the line that will make me question this whole bear market thing. I mean, if we take out that line convincingly, that means more than just a day, more than just a percent or two. That's at 45.90ish, and that's the line in the sand. So my plan again is to continue moving towards a net short positioning up until that level, not adding, and more concerned with beginning to rapidly scale out if and when this level gets taken out. Might not do an all or none stop. Depends what happens, and it as everything does. That's my plan right now, is to continue to take fewer and fewer longs, more and more shorts from here. But if the charts change, so will I. This is just a long-term trend line that goes back for a while on the NDX 100, so you can see the beautiful breakdown and back test. And that's, again, the bigger picture has been covered ad nauseum lately, so I'm not going to get into that right now. And here's the S&P 500 from a daily view. Same bullish divergence down at the lows. Nice, positive divergence on the daily chart. It's played out for quite a move. There's R2. That's that big, I don't have the line set exactly. It says 1993 here. So, give or take 1990 plus or minus a few points on a 2,000 point index. That's just minor. There's R3. So if we do fake out the masses and take out that 1990 level, I see a nice gap up there. Nice support shelf back here. You can see it define these reactions. And once that broke down, there was impulsive selling. So that's a significant level, and that's comparable to that line in the sand, that red line I had on the NASDAQ 100. So, if and when this level were to be taken out, that's 2340-ish, or or 2043-ish, I should say. That would be my give me a lot of pause on the longer term bearish scenario, because that would look like we're punching out to new highs. Again, I'll say it outright. I don't think that's going to happen. I don't think we take that out. But if we do, then we need to reassess things. We'll also look at the trend indicators and everything else at the time. There's a downtrend line, not the best downtrend line, a few reactions. So that's just above it. So, the ultimate, just squeeze the shorts and clear out just about all the short interest would be a move even above that R3, just a very quick pop, and then I would expect a near very strong meltdown from there if that happened, to keep the bearish scenario intact. Okay, I'll wrap this video up just going over a point that I want to mention, that, I've traded these type of markets before. I've traded the last bear market that we had. I was, trading, before the top in 2007 all the way through there. And there were periods, bear market rallies, which, I love to trade. Even during, some of the bigger corrections we had in this last bull market, we see this, that sometimes towards the end of these counter trend rallies, when the trend is down, you tend to see the junk, the low price stocks, the high risk stuff. That's where you start seeing a frenzy, and that is also usually indicative of a top. Now, we saw that yesterday. Here's the S&P 500. It was up 0.4%. There's right here, 0.41%. Now we look at the equal weighted S&P 500, which includes the regular S&P 500 is market cap weighted, so your bigger companies have a higher weighting. So the big Apples of the world, the Exxon Mobils. However, when you get down, use the equal weighting, it gives every component, roughly 500 components in there in equal weighting, and you can see that was up 0.73%. So it goes to show that the a lot of the bigger names actually lagged. It was the smaller names, the lower tier stuff. And, to take it a step further, let's just look at the IWM, which is the Russell 2000 ETF. That was up 1%. So, there's the small caps, and that goes to show that that's what was really driving the market. It was evidenced too by a lot of the names that we traded. Okay, to illustrate my point on the junk moving up, and to wrap this video up, I'm going to rifle through just a handful of stocks in my watch list. This is just one of many watch lists that I have. These are just my charts withdrawing. So these are stocks that I follow. I have a universe, thousands of stocks, and what I'll do throughout the day is sort this list. And so that's what you're seeing here. I've sorted it by the highest percentage gainer. The top Paragon, skip Paragon, I had a 1 for 38 reverse split. Usually on TC2000, this program, they don't make the adjustment till the next day, so they're showing that stock up 200%. That's probably just due to the split. The rest of these are true moves. Okay, I'm just going to go down quickly. This is RJet. This is an airline stock that collapsed. It's a penny stock now, so you had a 35% move. So that's kind of indicative of junk. Here's another penny stock, Intrepid Potash IPI. You can see that's number 3 on my list, really number 2, packing out Paragon, 30% move. It's a junk stock. That's just a one day up, one day down, up 30% today, down 30 tomorrow. X. Now the steel makers did have a great day. There's U.S. Steel, and that was a solid move, and it was confirmed. I mentioned this. Somebody pointed out yesterday that the big move in the steel makers, we had one steel trade idea on there yesterday. It's an official trade idea, but we also had all the other steel makers up. And as I mentioned, it's funny how the news, more often than not, will coincide with the charts. In other words, these are lines I had. This is a resistance level on X right here. And you can see, look at that little gap. You can see a numerous reaction from above, a breakdown, impulsive selling, another reaction. Boom, that's the level X took out on that news yesterday. And that followed this trend line break. There was a divergent low. I didn't update this chart. Forget about these notes. It's an old chart. I could draw it here, but you have divergence, positive divergence leading up to that low. So that was a beautiful chart. Then we have Cliff. This was added on as a long yesterday on a break of that the downtrend line, the support, and that also benefited on the news. and had a nice move up. But again, this was purely technically driven. I shouldn't say purely. The news coincided with it, but then again, like I said, this breakout would have been valid, news or not, and you would have probably seen a similar move. CHK, that was talked about yesterday quite a bit, but my point is, look at it. This is a sub $5 stock. Been beat down, almost visited. It was down to about $1.50 not too long ago. So you're going to see these big swings. And again, the theme here is this is junk. This is a lot of what's going up, and you can make a lot of money trading this junk when this is what traders are doing. Momentum traders are all over these stocks right now. And again, the music can stop anytime. It can stop today. It can stop tomorrow. Goal, I mentioned the other day when I put up the airlines, yes, there are a couple charts that are looking bearish, some airlines approaching resistance, but there's also, I have quite a few charts on some of the non-US carriers that look bullish. This one took out a trend line. So that was, again, this is a junk, low price stock, but it was lower recently. It's a $7 stock now, and they just did a 1-for-10 reverse split. That get it back up to that $7 level. But look, there's a nice resistance level I had here, horizontal resistance, and this downtrend line. It took out both yesterday. So that one actually might have some more room to go all the way up to about the $8 level. Doesn't look like much, but a point on a $7 stock is a pretty nice gain. So bullish divergence. I don't have it drawn out here. You can see the MACD from this point to this point making a higher high against prices making a considerably lower low. WTI, a lot of these little oil and gas E&Ps. This is a oil and gas, stock. You can see the little flag pattern here, broke down, fell quite a bit. Now you see a well-defined downtrend line and horizontal resistance. So this one, again, keep an eye on it. It's had quite a move to get there, so I'd be a little leery, a little cautious of taking a breakout. But if that one runs over, let's say 292, the 292 to maybe $3 area, and especially if crude holds up. This one, first stop on this one, I haven't updated this chart. I can do that now. The point of the takeaway of this, these are trade ideas for those of you looking for trade ideas in this sector. That's about 380 would be my first target there, and then I think that one might have a shot all the way up to 491. Could take a few months to get there, but who knows? In this kind of market, that thing could get there in days, especially depending on what crude does. So just watch it. It's one to watch. Let's see. Next, I won't go through them all, just a few more. WG. This one broke down from this trend line here, this uptrend line, came back. Here's the support level, just bounced off recently. But again, one of the bigger movers, 20%. This is a dollar, as of yesterday, after a 20% move, still only $1.66. There's another steel company, low priced, AK Steel, coming up on resistance. I wouldn't be chasing this one right here. In fact, I'd be more apt to look to probably put on a short there. Not that I'm going to do that, but point is it's coming up on a pretty good resistance level after a move that you can see this 120% move in just 1.2 months. ARO, penny stock, so you have a pop of 20%, but it's still, chart looks okay. It has divergent low, but play with penny stocks. These are, you can wake up one morning, if this one hasn't already filed for Chapter 11, sometimes you'll see them trading at this level, and they've already filed for bankruptcy protection, and it's amazing how many traders out there are oblivious to that in most cases, the shareholder equity is wiped out by the time the bankruptcy proceedings are over. There's nothing left. That goes to zero. So I'm not saying that one's filed for Chapter 11. I don't know. I don't even follow it. It's just on my watch list. I'm here. Last time I had a pattern on it was back in 2014. That's the only reason it's popping up on this list, because I had a drawing on the chart from 2014. TCK, look at that bullish falling wedge pattern. This was basic materials. I've had personally some basic material stocks on that I've held in the last couple months. They've been doing well. This had a nice chart. Don't believe I had this one personally, but wish I did. This is definitely a chart pattern I've had on it, and had that divergent low, and just must have missed I believe I missed that. I don't think I traded it. I don't know. Sometimes I trade so many stocks and watch so many, it's hard to tell. Hard to recall which ones I had. I have a stock, I buy it, I sell it, I move on. So either way, that one's now coming up on resistance. That a lot of that wedge has played out, and then some. it'll probably consolidate around this 750-ish level for a while, is my guess, and then ultimately, if these basic material stocks continue to go up, which I think so, that's where I think my money is going to be for the next year or two, is precious metals, commodities, resources, things like that are just beat down and have that intrinsic value that these companies like Facebook and all those others with crazy valuations, they don't have the same intrinsic value. It's just a lot of excess and fluff pumped into those stocks. Yeah, so that one, if you could put a downtrend line here, it might stall at that as well. But again, I wouldn't touch it until it consolidated and then took out that 750-ish level. SUNE, that's was an active trade on the site, and this one's been moving a lot, news-based. But you see, these are the big movers. We'll wrap it up here with XCO. XCO Resources. Look at this nice resistance level that it's been flirting with. Boom, 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 boom. We had reaction low here. That was where it broke down. It's had the numerous tags of this 137 level. Again, it's a low price stock. Overall, this has been bullish action. We had this downtrend line. Prices broke above it, have back tested it for a while, moving up. And, it's an oil and gas E&P stock like a lot of them. So, again, if crude holds up and there's a good shot that crude has bottomed, or at least is pounding out a bottom. And, these are stocks that if they don't file for bankruptcy protection, then over time, market conditions improve, the price of oil moves up. This one could run. I don't have any targets there. I'd have to study that chart a little further. But that's it. We'll leave it there. Here's another one I actually wanted to talk on. This one I had an alert go off yesterday, and it was certainly a trade I could have got in there, but the problem is I was watching. I had an alert on this bullish falling wedge pattern, but I have a resistance level right here, and we actually took it out. I was surprised to see us continue to punch through there. This is a biotech company, but I didn't take it, nor would I, even at this point. I think that's a momentum overshoot. I think the stock will have to come back in, maybe back test, but it could continue higher. Like I said, this is one of the ones I mentioned. There's some bullish charts that I'm seeing in the biotech sector. So I wouldn't be, that's what's giving me a little pause for shorting. If this one does maintain above this $8 level, it's probably headed up to the 890-ish level. There's pretty nice resistance there. All right, last one. This video has gone on longer than I wanted, but there's so many great charts out here. Freeport McMoran, FCX. Look at that chart, just beautiful. Bullish falling wedge pattern, bullish divergence in place, breakout, a tag of resistance right there at 605, pullback, push back up, hit that next resistance level. You can see how well it's defined by these reactions. Pulled back, took it out, punched up through it. It's a little minor resistance actually right here, so I wouldn't be chasing it. That one left the stables already, so I just want to point out that there are these charts, there are these stocks that even during a bear market still have more potential in the long run. You look how much Freeport's come down from the highs. That was a $60 stock, and it went down to almost $3.50. So again, I wouldn't be chasing it here, but these are the stocks that in the long run, just like the gold mining stocks that just had the tar beat out of them, in the long run, they have a lot of upside potential left in them. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.